Welcome back to Happy Investors, this time with 5 dividend stocks for this month that are very interesting for further research. This week, we have researched numerous stocks again, and in our videos, we share the most interesting stocks that we currently see. This doesn't mean they are the very best. There will also be failures, but some will perform significantly well and therefore more inspiration. And time is very scarce. Your time is valuable, so we will go straight to the point with the first stock. And what we are naturally going to look at is the long-term potential, not only for dividends, but also for price returns. And then theoretically, you could pick stocks that might achieve a high return, like this example, which we will look at shortly with an average return of 20% per year. Sounds too good to be true, but I think in this case it is not. In fact, it is my largest position at the moment. Evolution, it's quite painful to show, of course, but yes, sometimes you have good moments in your portfolio. And yeah, sometimes you have bad moments in your portfolio. And at the moment, due to the transition to EU stocks, it has initially turned out well. Still quite well, actually. Only Evolution is not doing very well, 22%. And I have been buying the position since the summer of 2024 and continuously added more. And the last transaction where I bought more of Evolution was actually last week. I shared that in the latest update of our investment portfolio at a price level of 62s. And now it is at 22%. Is that good? No, of course not. But I'm not worried about the long term. There is some uncertainty surrounding Evolution. I personally think this is truly a great moment to buy for the long term. And by long term, I mean more than 3 years. Also, give a company the time to recover and grow. At least recovery. It's a temporary setback in revenue and profit, if you ask me. So there is uncertainty around Evolution. We are going to look at a number of characteristics. We will go through them quickly. It is purely for information. It is not a buy recommendation. It is never personal advice. And it is always purely for inspiration. The fair value estimate for Morningstar is above 1,000 SEK, while the current price is slightly below 700 SEK, Swedish krona. We indicate that the economic moat is narrow. I agree with that. And personally, I think they are developing good ways to strengthen their moat, their defensible competitive position. The analysts are actually a bit divided in their opinions. 4 indicate a sell, others indicate a buy. Nevertheless, the average price target is also above 1,000, but still, the stock has been dropping a lot recently, and last week it fell significantly after the latest quarterly figures. Yet, I think it's all an overreaction based on uncertainty. If you just look purely at the strong business model and long-term growth potential, I think this is a buying opportunity, and we are going to see a number of characteristics. We now see that the price to earnings ratio has dropped to a low point of around 22.55, and you see the historical valuation that this price line, the black line, is far below what would normally be considered a reasonable price. We also see the dividend, of course, now at 4% and 7 consecutive years of dividend growth. So this is definitely a dividend stock, because the price has dropped almost 20% in one day. My portfolio is now also at 22%. Yes, so be it. As a result, the valuation has actually become very cheap, for which I think why it has a margin of safety large enough to certainly dare to take the risk. Analysts expect, and there are quite a few, that there will simply be EPS growth in the coming years. What does that mean? The normal multiple, that is around 32, which is actually not even absurdly high for such a growth company with a scalable revenue model like Evolution. Then, theoretically, you could achieve a return of about 300% in total over the next 3 years, which averages around 70% per year. Well, that is, of course, way too high. Always assume a cautious scenario. And let's stick to 16. A price-to-earnings ratio of 15 is somewhat normal. Evolution is of slightly higher quality. In my perspective, the stock could receive a slightly higher valuation. But suppose the EPS estimate below is accurate, and this applies to all the stocks we will discuss shortly. It is a forecast. It is never 100% definitive. But then you could achieve an average return of about 33% per year from this level. Will that come true? That remains to be seen, of course. Now, suppose we maintain a price-to-earnings ratio of 15 in the very long term, at least very long term up to and including 2030. And the EPS growth is on average about 11%, which seems realistic to me. Also, considering that the growth market for casinos is simply a growth market, as is online gambling. Whether you are for or against it, that is not at all up for debate when investing in this stock. It's about what the growth potential is. And this market is indeed growing. Moreover, they are still expanding in the USA and, for example, in Brazil. Two very large markets as well. So it seems realistic to me that such a stock can at least achieve profit growth of 11% per year from this current level, but it will come with ups and downs. What can you achieve then? Possibly even a return of 20% per year. Good document or wrong? The prospects are better than, for example, an S&P 500 or another ETF. And that means you can probably achieve a high return with perhaps a slightly lower risk profile. But risk is subjective. And of course, there is such a thing as uncertainty, and there is a lot of uncertainty surrounding this stock. Analysts do expect that revenue will grow somewhat, as we can see here, only that the margins for the coming year 2025, those margins are expected to decline. And that indeed has to do with temporary setbacks. At least we hope they are temporary, such as cybersecurity issues, where certain illegal parties, especially in Asia, are using Evolution's software without paying. And of course, nobody wants that, so they are working on fixing it. However, the CFO has also left, so it's not exactly a crown jewel at the moment, and I think these are short-term situations. Only if I'm wrong, then it won't be a good investment. So it's up to you as an investor. Research the stock and consider, are these short-term or more fundamental issues, and is the risk worth it, taking into account potential profit growth? Now, suppose that profit growth is indeed there, then the price to earnings ratio will decrease every year. Below 10 is really super cheap for this company. The ratio is therefore also lower, as we can see. If we look at the dividend, it has now significantly increased to about 4% per year. For next year, it will also be around 4%. They have also allocated 500 million euros for selling shares. So you not only have the dividend, but you also have the effect of shares they are buying back. And they have been doing this since the summer of 2024. But they are now going to buy more and more shares simply because the price has also dropped significantly. I think that is a wise choice for management, but time will tell. Look at the dividend growth figures. They are impressive. The 5-year annual dividend growth was just 67% per year. It may not be a great dividend stock yet, but since they started paying dividends, they have done so for 7 consecutive years, and the dividend has also grown for 7 consecutive years. So potentially this could be a very interesting dividend stock. And yes, actually, if the price stagnates at this moment, then you might possibly have a 4% return per year, depending on whether the company can, of course, keep its finances in order. But every once in a while, even a bad company has a good moment, and you can simply achieve pure returns on the multiple. In other words, the price to earnings ratio. So I think there is simply more upward potential than the market currently estimates. And I think that simply presents a buying opportunity. Where are the earnings? As mentioned, they have decreased. The PE ratio over the next 3 to 5 years is estimated to be around 0.65. That is well below 1. Good figures also look good. We see high profitability, where the net margin might decrease slightly in the short term due to some temporary issues. But no matter how you look at it, the return on equity is still very high. Even over those 5 years, it remains very high. The return on total capital is very high, so this all indicates a high quality stock. Of course, with any company, the crucial question is whether they can maintain or expand their competitive advantage. And can they continue to achieve revenue and profit growth in the future? In my opinion, yes. But in the short term, after the latest quarterly figures, it has dropped significantly, about 20% in one day. It is now actually at a very low level. And yes, theoretically, if you are looking for a support level in terms of technical analysis, it would be around 600, or maybe around this price level of 700, but it is actually just below that. Now, if you have a stock that drops significantly based on news, you often see it simmer down a bit further and stabilize, and then if things go well, it rises again. So this might not be the perfect buying moment, but you never know what the perfect buying moment is. Moreover, you are investing for the long term. And I think this dividend stock with about a 4% dividend per year, plus share buybacks, plus potential profit growth in the long term, that this can yield a high return for you at this moment, but for the very long term. The second stock that you might not consider as a dividend stock is Teleperformance, which I also have in my current portfolio. The first time I bought Teleperformance was at the end of 2024. Then I bought more twice at a lower price level and later sold a bit at a higher price level to bring the position back to about 6,000 on average. Otherwise, the position was a bit too large for my liking. I think it's very interesting, and actually, you should label this as a kind of value stock. It has been under significant pressure for a longer time due to artificial intelligence. And that is, of course, not very favorable for call centers, including teleperformance. But they made a large acquisition in France, which I think was a really good move. They have made another strategic acquisition. As a result, the debts have increased significantly. On the other hand, the growth potential really seems to be there. And my thesis is that call centers are still needed because when people have problems, they just want to speak to someone on the phone and not an AI program that cannot properly handle and understand the emotional situation of, for example, frustrations, but can completely miss the mark. And maybe in 5 years, the thesis will be different. But I think for the coming period, it is interesting enough. But we will see what time will bring us. The current price level is $90, and I think a good entry point is around a price level of $80. So I don't know if we will reach that, but we will see. The fair value estimate is 128. Analysts indicate 14 as a buy, 6 as a hold with an average price target of $140, so significantly higher. If we look at the historical development in terms of valuation, it has become significantly overvalued over time, and you see a massive price drop of about 80%. We have also previously emphasized that teleperformance can be interesting. So we entered somewhere here at the end of 2024, maybe just a bit too early. The price is stabilizing, and hopefully it will naturally rise. The potential return could be based on the normal multiple, which is equivalent to 18. Could that yield a return of 65% on average per year? Well, let's be a bit more cautious with a multiple of, for example, 11, or even more cautious with 9. That means with the EPS growth we see below, it could still achieve an average return of about 30% per year, even if the price to earnings remains the same and the company, which is crucial, achieves this profit. Then you still have a high return plus that margin. Whether all of that is achieved is, of course, still a question. You know how the model works. It's an estimate, a forecast, and they are often off. Even in the long term, it has the potential to realize high returns. But the long term is, of course, even more uncertain. And for the very long term, we definitely need to take artificial intelligence into account. The company has invested quite a lot of money precisely to benefit from it. They have a lot of employees, hundreds of thousands. And yes, I actually think that artificial intelligence can help them to have at least fewer staff and make that staff even more effective. And that should actually lead to a significant cost reduction plus higher profits per employee. And that simply means more money. So I actually think it's only beneficial. But yes, we will see. The forecasting still shows some revenue growth also from other analysts. We see some figures here like the price to earnings ratio, which should decrease if you make more profit, and the PG ratio, which actually seems to be relatively cheap. Let's look at the dividend at the moment, a dividend yield of almost 4%. Dividend growth figures don't seem very impressive. It's also not a top dividend stock if you're purely looking at dividends, but it's about a combination of price return plus dividend here. Looking at the dividend growth, it's at 0 years, but that's only because of the last year. By the way, the dividend payout is annual. Keep that in mind. But they have paid dividends for 10 consecutive years. And I think something like this, the feeling, so to speak, that they just want to secure that. A major risk here is they have relatively high debts due to that large acquisition. If we look at the short-term cash position, it is 1 billion compared to long-term debt of 5 billion. So short-term solvency seems to be in order, but the long-term, you can suddenly face major setbacks, and then they will indeed run into problems. So keep that well in mind. The PEG ratio is at 0.5. This theoretically means that you have a safety margin of 50%. Well, that is high. And if we look at the growth figures here, it also seems to look good in the short term. 6 months ago, it seemed less promising. I had already invested then because I thought, yes, it will get better. And in the meantime, these kinds of databases have also been adjusted to the new reality. Sometimes you're right, sometimes you're not. But at this moment, it gets a buy. Whereas 6 months ago, the factor analysis was still a sell. So that is quite a big difference. Then we look at the net income margin. It is not very high. That is not very positive. On the other hand, the EBITDA margin is fine. So take those costs into account. Interestingly, the moment in the short term seems to me to be around the price level of 80. In the very short term, it actually dropped significantly last week, probably due to news. If you zoom out a little, you see a massive price drop. Actually, the current price level is still around the price level of around 2017. I think this is an interesting entry point for both return and dividend. More than a year ago on Happy Investors, we published the dividend stock of Manulife Financials. On Investors, we offer paid analyses for $99 per year, including dividend analyses with one top dividend stock per month, plus a monthly update of great dividend stocks possible. Manulife Financials was in our selection more than a year ago and has achieved a return of about 40%, excluding dividend. So that was a good move on our part. High return than average. So that's what you do it for. The ticker is MFC, and at the moment, the company still looks strong. The upside potential in terms of price return may have decreased somewhat at the moment, but it is still a really strong dividend stock. The estimates are around the 40 cut. And if we look at the analysts' findings, they think it will rise slightly. But if we look at the historical valuation, we see that it is still below the potential valuation. However, this will come with peaks and troughs. If we look at, for example, the normal multiple, it was around 8 for a while. Based on 20 years, it was 15. Well, we think financial stock, let's use a price to earnings ratio of 10. Then the average return doesn't look super attractive. Admittedly, it's around 8% and a very strong dividend. So in terms of dividend, it scores well, but perhaps less so with price return at the moment. When we selected Manulife a year ago, it was, well, how do you say that? A bit more undervalued, and therefore it also created more price return, potentially just like Evolution and Teleperformance that we discussed earlier. But that price difference has now increased to the point where there is less undervaluation in the very long term. And it can, but that's all theoretical. Achieving an average return of over 10%, at least with a multiple of 10. If the EPS growth of 12% is realized, that seems a bit on the high side to me, but time will tell. You see in the revenue developments, that is the black bar here showing increases and then significant declines and then increases again, indicating a sort of cyclical movement. Keep that in mind with these kinds of patterns from the past. That often means the business model is probably not super stable. And this also makes it more difficult to determine good entry points. However, if you invest for the long term, it's really about the long-term growth. And then cyclical tendencies matter less. Theoretically, it can probably drop with profit growth to below 10. That is interesting. The PE ratio is also interesting. Looking at dividends, that's what we do now if you want a dividend stock. The dividend yield at the moment is almost 4%. For next year, above 4%. The dividend growth figures are good, especially the 10-year 8% dividend. Growth per year is not bad. That dividend growth has been realized for 11 consecutive years, of which they have been paying dividends for 24 consecutive years. So it is almost a dividend aristocrat, as we call it. Looking at the valuation, yes, it is somewhat neutral. Actually, not a lot of good things. The price to cash flow seems very low, but this is, of course, a financial stock. The balance sheet is naturally also a factor to consider. Growth, not really impressive. However, profitability is reasonably good with the high EBITDA margin. Net income margin is not bad. But look, 18% compared to the 5-year average means that we might even return to the older level. I just find profitability, ROI, ROE, those kinds of things, not really very high, but high dividend. You see the strong dividend history, so it can be interesting. We have the menu live, so selected somewhere. In 2024, early 2024, it rose a lot. At the moment, there seems to be a resistance level for around 32. It's almost there. So it might be worth just patiently waiting to see what happens here. If you ever drop to 24, sounds on the low side. Is that a buying opportunity or maybe around 27? All in all, I would personally wait a little while. Maybe if you're lucky, there will be a significant drop in the short term, perhaps also due to all the macroeconomic developments. And if that's the case, then a better buying opportunity arises to create at least a bit more margin of safety. Where Manulife Financial actually has a very strong dividend, the stock is not Barclays. Still, I mention it quickly because last month we also mentioned this stock and it looks fundamentally very strong. Then it dropped significantly due to all the levies in the market, of course, but now it has also quickly risen again to the current level of last month. It could be that this is actually the last resistance. It will break through, and As a result, it could rise significantly. We'll see. But at the moment, I think there's an opportunity here. Morningstar's value estimate is somewhat lower than the current price, and analysts believe there is a short-term potential gain of 6%. The factor analysis is very strong for this stock, and I often see this pattern with these types of stocks. I personally do not invest in Barclays, but it could be, especially if you have more knowledge about the developments of this bank, that there is potentially a high price potential, at least in the short to medium term of 1 to 3 years. Looking at the historical valuation, we certainly see, especially when we zoom in on 7 years, that it may be significantly undervalued. However, this price to earnings ratio is quite high. So let's take a look at the normal multiple. That has been around 6 in recent years. Well, that is somewhat on the low side. However, that price to earnings ratio has risen to 8 due to the stock price. Rapid price increase in the short term. Analysts therefore expect a significant EPS growth, as we can see below, which means that even with a current price to earnings ratio of 6.4, based on a 5-year average, the return is still about 10% per year. But if we use a slightly higher multiple, like 9, for example, and you take 9 or 10, well, he definitely doesn't feel like it. Then you have a higher return of about 25% per year on average. If we look at long-term growth, development, and an EPS growth of 70% is achieved, then the return is even higher. But of course, that's really a rosy outlook. Thinking about the future, we don't gain much from that. I think in the short term, it might be interesting enough to analyze for a moment. I don't invest in it. I don't have enough expertise. Unfortunately, those are my limitations. Financially, stock bank. I usually avoid that. But the characteristics are such. I see this pattern more often. It might achieve high returns. Analysts also think that revenue will increase and that margins will rise in the coming years. So that looks interesting. That also means that the price to earnings ratio will drop to, for example, below 6. Well, that seems cheap. As a result, the PE ratio also turns out to be quite cheap. But you know, everything with financial stocks, that can suddenly be very different, especially because they, of course, work with a lot of loans and such. And you also see the effects of Trump, what that has had on, for example, bonds. So there is always uncertainty. The dividend yield is currently 2.7%. That's very low, right? What struck me was that for next year, the estimated dividend is expected to rise to 3.6%. The dividend growth figures are not interesting at all, actually. Also, the dividend history is not interesting at all. So it's actually not a strong dividend stock. But the composition, and possibly higher potential dividend in at least the medium term might be interesting. So this is actually more of a short-term approach. Well, that PE ratio is estimated to be well below 1. That simply means undervalued, but it remains to be seen if that's true. We see that the factor analysis gives a strong buy and actually a very high score on where all the figures here are relatively good or favorable. This means that Barclays is relatively cheap and that the stock statistically has a chance to outperform against a very large data set of various stocks. But it is not 100% truth. It is a combination of various tools we use that actually allows us to identify stocks that might achieve higher returns. But the next step, the most important step, is fundamental research for the long term. For me, Barclays is not interesting. I also have no expertise in this sector, but certain aspects, as we have considered now, look interesting. In the very short term, there is a resistance level around a price level of 300. It will be very interesting to see what happens if the price breaks above that level. You see here a candlestick with a little line, and that line here actually indicates the price level. So last week, it actually touched that resistance level and then declined. So I'm really curious to follow what happens if it breaks above that level and whether it continues to break through further, yes or no. But of course, that's just technical analysis, and that's the last thing we look at. Why do we address it last? But this idea might be interesting for more short-term traders, or if you believe that Barclays is going to do very well in the next 2 or 3 years, or perhaps in the long term. Do you have more insights on this? Please let me know. I find it interesting to learn from as well. And yes, thank you for that. As always, finally, we have a strong dividend stock for the long term. Tyson Foods with the ticker TSN is also a stock that we mentioned last year in our selection of happy dividend stocks. And check the website for more information. The fair value according to Morningstar is $80. The current price is $60. And analysts also think that the price might rise slightly in the short term. Tyson Foods is actually a kind of turnaround story based on earnings. It has dropped abruptly in the last 2 years, which was naturally a bit concerning. As a result, we see that, yes, a significant price drop has occurred, and at the moment they are still somewhat in the process of recovering. If we look at a piece of potential return, well, the price to earnings has increased. Based on a 10-year average, the normal multiples are 13.5. I see no reason to estimate higher. Analysts think there will be EPS growth in the coming years, and actually quite substantial growth. So that can be both advantageous and not. If we look at the average returns at that time, it would be 8.6% on average per year, including dividends. Well, you see, this setup implies some uncertainty, such as higher EPS growth estimates that may not be true, so they could also be lower than expected. Often, the higher the expectations, the higher the potential uncertainty could be. Or I should actually say, the higher the chance of disappointment. And you also see that in 2023, the profits had significantly declined. In 2024, it is recovering significantly, and analysts expect the pattern to be that revenue will increase slightly and profits, but it will rise again. So a kind of turnaround, but that naturally always carries some risks. As a result, the price to earnings ratio will also decrease. The PE ratio therefore seems to be somewhat cheap. Looking at the dividend, it's currently 3.3% and the same for next year. Especially the dividend history is very good. The dividend growth seems poor. Only when we look at the 10-year dividend growth, it is indeed very strong. This is somewhat related to the recent developments of PSN in terms of dividends, where they have achieved dividend growth for 13 consecutive years and have been paying dividends for 35 consecutive years. You can imagine that management would want to maintain this 35-year streak. Other figures estimate the ratio at 0.77. Looking at the growth figures, yes, they look somewhat extreme. That has to do with this story. This makes it more difficult to analyze. For me, it's a no-go. I also find the sector not very interesting. We are looking at profitability. It seems poor, but of course, that also has to do with those margins that are just scraping by. So actually, the story is whether this company can return to, for example, a profit margin of 3.5%, which is certainly not high. Yes, then it seems that if the revenue just grows and the profit in absolute terms also increases, that the stock might currently be somewhat, let's say, favorably valued. Plus the dividend that you receive annually, of course. Well, in the very short term, there is a sort of range. You could say a trading range with a support level at 53. I would always say in these kinds of situations, follow the stock, remain patient. Maybe it will hit 54. Do you have a bit more? Do you still want to buy at a more favorable price? Or maybe it will drop further in the short term. Moreover, there might also be some uncertainty due to the aspect of recovering profit margins. Compared to the last peak, it has still dropped significantly. So for the very long term, the question is actually whether Tyson Foods can, one, return to the SAR average profit margin of the last 5 years, and two, based on that, grow further with future growth. And, of course, more profit. And the latter is, of course, where you need more expertise in the sector of the companies, of the competitors. You also want to look at the management. So in other words, fundamental analysis. These were 5 interesting dividend stocks that we see at the moment. Of course, the insights are somewhat different from most dividend stocks. These are mainly stocks with interesting dividend potential, but also simply return potential with pros and cons. Some seem to be very good and stable, while others have more uncertainty, but possibly also higher return potential. I'm curious, what do you think? Let me know. Thank you for watching, and see you next time.